Hello, welcome to my presentation. So today I will be discussing about Green PLC, a UK tax resident company that has come up with a new product of a new clothing product that is manufactured from recycled plastics, and we are looking into launch options. So I will be critically evaluating the launch option of self-manufacturing the product using different appraisal techniques, and that is what I have to present to the management or to the CEO. I have prepared a wonderful presentation regarding that, traversed every dynamic aspect, quantified the facts, revised the errors, and suggested what needs to be done in order to make this a huge or a massive success, including high-level recommendations in the executive summary. So hold your breath tight, and here we go. This is the index, and it has total 25 topics. I will not make the presentation boring, but reading into the index and reading, out every line of the topic of the index. So you can have a look. The total number of topics we will be covering today in the presentation is 25 topics. Executive summary. Let's start with the brief. I will be walking you through the executive summary. After the entire presentation, we will be able to prospect better and focus on the recommendations, drawbacks, and advantages that I have discussed in executive summary. But to give you a brief, let's go with the first point that says that Green PLC is a public limited company, which means that it holds a dominant position in the market, and its failure will disturb the UK economy massively. So, point to be noted that in the post-COVID era, where inflation is at the verge, inflation is taking over, reducing the purchase power of people. So in this situation, it is a massive hit for the UK government or the UK economy if Green PLC goes through a failure due to this product not being launched through the correct launch option. So we cannot afford that, okay? And that is the reason, as a product manager, it was very, very critical and important for me to review the future of this investment project that involved the development of the new clothing material using recycled plastic. Next, what I will be discussing is that I would like to recommend Green PLC to go for contract manufacturing. We will be going, sorry. I'm sorry. So we will be going through the presentation, and we will be discussing that the first option of photosynthetically manufacturing the product or self-manufacturing the product is a very bad or unhealthy option at this point of time, because it will lead the company into nothing but utter bankruptcy, and we cannot afford that. It is very important for a company to succeed and based on the investment. So basically, for a company to succeed, what we need is continuously a constant investment in the R&D, in the research and development. So in order to do that, what we will be needing is that we launch the product using the correct launch option so that it's a massive hit. Green PLC, the cost of equity, that's 12.5%. Role of cost of equity. For example, any new company with a project cost of, say, 100 million needs to be financed by multiple resources of funds, example, equity, debts, etc. Every source of fund has a different cost coming with its own set of risks and control. The management's aim is to evaluate every above factor with the goal of shareholder maximization and involving minimum risk and having maximum control. So here I have personally made an effort to point this out. How is the value of 12.5% related to Green PLC? Cost of equity has been derived dividing the dividend per share of the 50 pence by the face value per share of £4. This is derived in the form of expected dividend for one share of a shareholder. I've stated above fact from the point of view of a CFO, the Chief Financial Officer, in order to maintain the price of the equity in the London Stock Exchange. Now, Green PLC, the cost of debt is 5%. Previously, going to the previous slide, I will just give you a gist. Cost of equity, 12.5%. We need to keep this in mind as we move through the presentation. Coming back to the cost of that's 5%. So what is the meaning of cost of debt, and what is the role of the cost of debt in Green PLC? So on the right-hand side, the rate of interest at which the lenders are willing to invest in Green PLC to finance its activity, that is launch of the new product option as launch option, new project of financing the operational units and its activities. So this is the highlight of this slide. For every slide, I'm going to focus on the highlight, because if I focus through every point, it will be a huge presentation, like it will take 41 hours. So what I'm going to do is discuss about the weighted average cost of capital. Right now, it has shown me, it's shown in a beautiful calculation, and it has come as 10.03 WACC of weighted average cost of capital. B denotes weightage of each source of fund, that is equity and debt, in the total capital employed, while C denotes cost of capital, that is 5%, which is applied by the CFO and the given data itself. Green PLC WACC 10.03%. So WACC of Green PLC is 10.03% as calculated in the subsequent slide. It indicates average cost of capital, taking into consideration all sources of funds with their relative weights in the capital structure. As a highlight, I would like to mention that the WACC needs to be updated. It's not updated. So the advantage of using WACC method of appraisal technique. As an appraisal technique, let's discuss it. So basically, it saved the company from moving into bankruptcy by evaluating the project and making us reject it by giving us clear indication that it's a no-no to the appraisal, to the launch method. That's option 1 of in-house manufacture of the product. It indicates that the average cost attracts investors and finds out the minimum rate of return at which a company produces value for its investors and for the management by indicating negative cash inflow and giving a sign to reject the launch option. Simple. Moving to the next slide, that is, I have created this formula in order to make it simple. So let me go through it. It's WACC refers to weighted average cost of capital, and how to calculate it. This has been calculated by finding the weightage of each source of funds within bracket, debt and equity, etc., in the total capital employed by the company into, that's multiplied by, again, individual cost of the capital multiplied by the individual weightage of each source of funds. Next slide. NPV as an appraisal technique. This explanation. NPV here has been used as another capital budgeting appraisal technique. Outflow and inflow of Green PLC has been calculated and then discounted at the rate of 10%, which has been used as the cost of capital. The initial outflow and total annual influence is scaled over the project life cycle period and then multiplied to the present value factor, PVF, or for the period. NPV calculation. So here we can see that the NPV is it's in negative and it's highlighted in yellow in case the discounted present value of the inflow in aggregate would have exceeded, or if it would have turned out to be positive by decreasing the initial investment or outflows, then it could have been accepted by the management. So based on NPV results derived from the given cost of capital weighted, it's not acceptable because of the acquired negative value. So the NPV is in negative and it's highlighted in yellow, also mentioned below in blue and in black, blue background. Next. It's negative. So moving to the next slide, advantage or usefulness of using NPV as an appraisal technique. Oh yes, that's what we need to know. This technique has been used by management to prevent cash outflow and thus has used the given cost of capital to reject or close the prospective launch option. So the advantage, that's option 1. So the advantage of using this appraisal technique to evaluate option 1 and reject it. Plan to manufacture the clothing product in-house as a launch option basically saved the company from going into bankruptcy. That's what I mentioned in the very beginning. It would have been a disaster. All thanks to the technique, appraisal technique that we have available with us. So why did we not choose option 1? Now, summarizing it, NPV appraisal technique has been brought into light using this NPV appraisal technique, the flaw and the drawback of this option. NPV appraisal technique has been utilized here on the given information and data. Net cash outflow was derived. The result derived was that ultimate cash flow on a net basis derived is negative. Hence, the product launch option was rejected. Therefore, we have not chosen option 1 as it would lead the company to incur loss and offers no benefit to the company. Now, the cash flow statement, the summary of transactions leading to inflow and outflow, that is basically the cash flow statement. So I have I have brought out the most attractive parameters of the cash flow statement. So let's have a look. The most attractive parameters of this cash flow statement is the absence of interest portion in calculation of outflows, Secondly, the loan is irredeemable and more like a capital than a typical loan. So this is the most comforting thing that can happen in a business. When a loan doesn't feel like a loan, it feels like a capital. So yes, the loan is irredeemable and is more likely a capital, is more like a capital than a typical loan wherein we have the pressure. So it's very comforting. It's a very comforting factor. Next slide. So payback calculation. The payback period indicates payback period of time, which is the total cash inflow equals the initial investment made in the project. And we will be discussing here, what I have done is I have clearly and in details discussed every step which is there in the slide. And what I will highlight is the value, that is 1.498. The calculation is there in details in the slide. So updated value can be derived only when updated information is provided by the management. This can be achieved by improving the cash inflow in every period, which can in turn be achieved by increasing selling price and decreasing the cost of raw material or the cost of production. This is the calculation with the parameters and the keys explained, D1, P0, and the cost of equity, that's 12.5%. Cost of debt, 5%, irredeemable loan capital. Each loan is supposed to be refundable, but the given loan is said to be irredeemable. Hence, the notional cost of debt is taken at the rate of 5%. Some of the main differences between private limited companies and public limited companies in UK include, I have managed to, bring out the best points and the best bullet points that is going to sort out the private and the public limited companies, in UK, and that is public companies can offer the shares for sale to the general public, whereas private company has to arrange the share capital privately and cannot offer the shares to general public. So yeah, public companies, we can sell our shares to the open market, to the public of the economy, but in private company, we do not have that benefit. Now, the second point, the second difference is 2 directors are required for public companies, whereas only 1 director is needed for a private company. Let's have a look at the functions of the stock market. The main functions of a stock market are the facilitation of safe transactions, price discovery of securities, and driving economic growth, encouraging citizens to invest their savings and attract foreign investments. The stock markets provide following services to the various stakeholders. We will cover 8 points, and that is price discovery. We promote the stock market, promotes investment of savings, promotes better allocation of capital, becoming a medium of foreign investments, and driving economic growth and being an economic barometer. What is a barometer? Barometer measures the pressure of the atmosphere. So similarly, if we relate it as an economic barometer, this is the measuring parameter, the parameter based on which measures what is the economic pressure, whether the economy is taking a hit, whether it's running into inflation, whether there is an economic crisis, or whether we are at the top in the global market by monitoring, this is done by monitoring the Sensex, the shares of every company, and that is spread across the market, that's London Stock Exchange. So driving economic growth and being an economic barometer. Liquidity, safe transactions provide scope for speculation. We can predict or we can speculate to some extent positively, not like in a hysteric way, but yeah, definitely a little bit can be considered healthy. But yeah, of course, we have facts and figures to support and make it more quantitative and solid. Advantages of listing Green PLC. Below, I have listed the advantages of listing Green PLC. So comprehensive marketplace. Oh yes, it's the most comprehensive marketplace. Scale up operations, visibility, largest exchange, unprecedented reach, settlement guarantee, broadcast facility for corporate announcements, trade statistics for listed companies. Disadvantages of listing Green PLC. First and the worst disadvantage, that is loss of control. Oh yes, there are so many people involved in a listed company. I mean, the entire market, there are shareholders, investors, the stakeholders. So yeah, the more it's, the better, that's true. But we do lose control because there are so many hands in it, so many hands in the pro. I'm not saying that it spoils it, it's good, but it's also right that we have to face this loss of control. The biggest disadvantage of taking a company public is that the promoters tend to lose control over the workings of the corporation, the how the hierarchy is working, the pyramid is working, the process, the operations, we lose control of it. Loss of privacy. Privacy can be an extremely important asset when it comes to conducting business. Nothing should mess with the privacy of the business, or else the business is going into bankruptcy for sure. I mean, it's going to take a hit. Performance pressure increases to a great extent. When you list a company, it's representing the entire, not just economy, but the nation at a global level. So it is a very, very big pressure. It's like walking on thin ice. Cost of compliance increases when the company is listed on the stock exchange. Green PLC sales projection, here we have it beautifully done. Then we have Green PLC number, total number of shares mentioned over here. Then I have calculated Green PLC calculation of total capital, fund, equity and debt fund. We have the calculation over here. And then I have taken a slide to explain beautifully explanation of the fact that 10% is not an appropriate cost of capital based on the calculations. So the given option 1 factually analyzes and comprehends with other relevant and data, and the following points surface. So we will be covering 4 points. The first will be that the only relevant cost of capital is cost of equity, which is 8.37% in the calculation of WACC. There being no factual debt upon the company, the notional cost of debt is 5% for the irredeemable loan capital. Its weightage value, 1.65%, is totally irrelevant. That has been achieved using the NPV appraisal technique. The marketing and campaigning cost has been given to be £75,000 per year uniformly, whereas for all practical purposes, this cannot be the practical fact. Hence, it should be having a falling value. It should have a falling value per year and should have been zero or negligible with every passing year. So this is very important. It should have shown a fall, which it didn't, and it should have been zero. So last but not the least, selling price. Technically, selling price has also been given uniformly up to 3 years and thereafter showing a decline in the 4th and 5th year. Okay, as a matter of fact, it should have increased. Higher the selling price, higher the profit. I mean, we are here to make profit, make money, right? So why is the selling price falling? That means that the technique that a 10% cost of capital is absolutely a disaster. It's absolutely not acceptable. It's absolutely not wise for the management to accept it. And we are not saying okay to it. We are not saying okay. We are not choosing it. Okay. So as a matter of fact, it should have increased with every passing year, thus increasing the degree of acceptability of the product in the market. That is the demand of the product in the market. The next slide. Conclusion. We have seen that the 10% given cost of capital used for the stated purpose of calculating NPV is too high, as it has resulted the NPV to be negative. Furthermore, the individual cost of capital as derived for equity is only 12.5%. I've observed that in option 1, no salvage, but this is a very important point, and I have kept walked the extra mile to knock this point or bring this point into light, because I think that suppose we accepted option 1. For example, we are not, but just for a second, imagine we accepted option 1 of self-manufacturing the product, taking a hit, being okay with the fact that we are running into loss, taking a huge risk that maybe we will incur, we will draw money from the market and make huge amounts of profit. So we are going like totally blind. We are having totally blind, but then we go with option 1. But still, if we do that, I have observed that in option 1, no salvage value has been supplied for the machinery, and it is bound to come into existence by the 5th year when we would want to introduce a new variant for the product, thus discontinuing the product, right? So in order to the company to succeed, we have to continuously keep investing or reinvesting our profits in to empower the R&D for the sustainable development of the company as well as maximize profit. But if we go with option 1, we will be having the problem with the salvage value of the machinery, which has not been supplied. And when the product is discontinued as, investment as a scientific strategy, as to bring something new, as an R&D strategy, it will definitely show up. So not a good idea. Option 1, definitely not a good idea. Last but not the least, taking the above facts mentioned in the previous slide into account, the product manager must be supplied a comprehensive factual analysis and rectification or revision of above factors, which is compulsory in taking an imperial decision. If this stance is not followed, the decision made is bound to result in an imbalanced and impractical decision. So basically what we will do is we will not go with option one. This option one was coined by the management. I can clearly state or diagnose and give my analysis that it was done on fact analysis and gut instincts, right? But that is such, not a very clear or a very solid way of analyzing or appraising a technique or taking a risk or launching a new product in the market. So what I have done, I have quantified the proposal, I have quantified it, I have revised it, supported it with facts and figures. And what I have done is I have said to come up with a better plan and a product launch option. So what I'm doing is we are saying no to this investment appraisal. It's a clear no. We will not invest in this launch option. We will not go ahead with the project. Okay, I mean the product launch option. We will not go ahead with the investment appraisal. So that is the bottom line. And in order to make this a success, we will be taking all this into account and revising, coming up with a new plan. So the product is a massive, massive success. Now let's go to this executive. And of course, these are the references. Yep, these are the references. Now let's go to executive summary. Here, I have mentioned in future, I would recommend Green PLC. So the 2 points that would lead the product to be a success is that we have solved the problem. We have said that this is not a good appraisal technique, but what can be done? We should go for a contract manufacturing or business outsourcing when we do not have the resources and when we are not sure or we want to play it safe, then we definitely should not be shy to seek support. First, we earn profit, maximize profit, contract manufacture the thing, outsource our business, manufacture the thing, earn huge profits, then we can think of in-house manufacturing. And the most important part, in future, I would recommend Green PLC to revise the cost of capital to achieve a low WACC of 3 to 4% approx. This WACC will help us achieve maximum profit at low cost of production. Thank you so much.